battery packs with massive partners like milestone for the company here. For the first time in its corporate
35 daily swaps per station. They are operating smart cabin and autonomous software narrative.
strong as the L90s were last, handled 2.07 million swaps. We're
Spring of investor pessimism. Half the market.
Is this stock overvalued or undervalued? Could this stock gain 100% until the end of the year? Stay until the end of the video and to know the answer.
looking directly at the tape right now. As of early March 2026, we are seeing what I can really only describe as a massive, frankly violent recalibration in the market's assessment of NIO Inc. Pauses. Following the Q4 earnings announcement, the stock just gapped up. It jumped over 10%, trading right around $5.67. And it's a fascinating moment when you step back and consider the sheer volatility we've witnessed over the last 12 months. We are looking at a 52-week range stretching from a low of $3.02 all the way up to $8.02. But the price action isn't even the most compelling part. The volume data behind this move is simply staggering. As of March 9th, 2026, the short interest on the New York Stock Exchange stands at exactly 147.25 million shares.
Yeah.
And when you factor in the average daily trading volume, that gives us a days-to-cover ratio of 3.75.
The pressure there is pauses. Well, it's palpable. And I think we need to unpack what that 3.75 days to cover metric actually implies for the underlying psychology of the market right now. When you have nearly 150 million shares sold short, you essentially have this massive, tightly coiled spring of investor pessimism. Half the market is actively, structurally betting that this company will fail. A ratio of 3.75 means that if every single short seller panicked today, if they all tried to buy back their stock to cover their positions, it would take nearly 4 straight days of total market volume just to absorb that demand. Every single data point right now, every press release becomes a potential trigger for a violent directional move.
Exactly. It's a powder keg. And the fundamental catalyst driving this sudden price action, the underlying data point that actually forced this 10% upward jump, is the release of NIO's Q4 2025 financial results on March 10th. We are looking at a genuinely historic milestone for the company here. For the first time in its corporate history, NIO achieved a quarterly net profit under US GAAP, reporting RMB 282.7 million. And we should be very clear about what GAAP means in this context: generally accepted accounting principles. This isn't some adjusted, creatively massaged EBITDA figure where they back out stock-based compensation and pretend it doesn't exist. It is a true standardized profit, and this was driven by total revenues of RMB 34,650.2 million, which represents a 75.9% year-over-year increase.
It is a significant print. Objectively speaking, I will concede that right out of the gate.
It is much more than just a print. My position on this is that this Q4 inflection point definitively validates NIO's entire high capex multi-brand strategy, and specifically, their proprietary infrastructure moat. For years, the market has ruthlessly penalized them for spending too much money building out their ecosystem. They burn too much cash. That was always the narrative. But these numbers prove the model works. The company has successfully pivoted from a cash-burning startup into a state of structural profitability. The multi-brand phase is scaling exactly as management promised, and the infrastructure is finally yielding real financial returns.
While I completely understand the temptation to pauses to extrapolate a single quarter of positive GAAP net income into this grand, sweeping narrative of structural victory, I have to take the opposite view. Yes, the Q4 numbers look robust in isolation. I am not debating the math of that specific quarter, but they mask a much more brutal reality when you pan out. They are masking a massive full-year net loss of RMB 14.9 billion for 2025. You cannot look at a 282 million quarterly profit and just hand-wave away a 15 billion annual loss. The underlying battery swapping infrastructure, which you were calling a moat, remains deeply underutilized. And the company is still highly leveraged, navigating intense capital requirements while fighting a bloody price war at home and executing what can really only be described as a humiliating retreat from the European market.
I see why you emphasize that full-year loss. I do. But let me give you a different framework for how we should evaluate that past burn versus the current forward-looking trajectory. The Q4 data reveals that their volume scaling and their aggressive cost optimization have fundamentally fixed the unit economics. They delivered 124,807 units in the fourth quarter alone. And because of that scale, we saw vehicle margins expand dramatically to 18.1%. That is up from 13.1% in 2024. Expanding margins by 500 basis points during a domestic Chinese price war is incredibly difficult. It is almost unheard of.
Margin expansion is critical, absolutely. But we have to ask how they achieved it, and more importantly, whether that mechanism is actually sustainable in the long term.
They achieved it through deep technological maturation. The transition to their NT 2.0 vehicle platform is now fully optimized. But even more importantly, they are reaping the financial benefits of extreme vertical integration. Let's look at the silicon, for instance. The in-house Shenji NX 9031 autonomous driving chip, which is built on a cutting-edge 5-nanometer process. To put that in perspective for a moment, moving to a 5-nanometer process means they are packing supercomputer-level processing into a microscopic space. They've essentially replaced 3 bulky, highly expensive, outsourced NVIDIA Orin X chips with one highly efficient in-house brain that drastically cuts down the bill of materials cost for every single car that rolls off the line. And yet the broader market is completely ignoring this technological leverage. Look at the valuation disconnect. Today, NIO trades at a forward price-to-sales ratio of just 0.53x. Compare that to its immediate peers. Li Auto is trading at nearly double that, at 0.94x. XPeng is sitting at 1.06x. And NIO is projecting 47% revenue growth for 2026. At 0.53x forward sales, the stock is severely, almost irrationally undervalued.
I come at it from a different way. I don't see an irrational undervaluation here at all. I see a perfectly rational infrastructure discount. The market isn't ignoring the margin expansion on the vehicle side. The market is accurately pricing in the systemic risk of NIO's dual identity. They are trying to be both a premium automaker and a national infrastructure provider simultaneously. You cannot value NIO simply on the 18.1% margin of the cars they sell because those cars are permanently tethered to massive ongoing capital requirements. They plan to roll out 1,000 new 5th-generation battery swap stations in 2026 alone.
Which is exactly what builds the moat.
Which is exactly what drains the treasury. Let's look at the leverage and the dilution risks attached to that supposed moat. In Q4 2025 alone, their interest expenses were RMB 205.1 million. That is capital bleeding out of the company every single quarter just to service their existing debt. Furthermore, we have the 2026 stock incentive plan hanging over the equity, threatening common shareholders with substantial dilution. And they are doing this while the company continues to burn cash to survive the intense Chinese EV price wars. Yes, they have an RMB 45.9 billion cash cushion on the balance sheet. I acknowledge that. But when your full-year net loss is nearly 15 billion, that cushion can deflate incredibly rapidly if the macroeconomic winds shift even slightly.
That's an interesting point on the cash position, though I would frame the capital expenditure completely differently. The spending isn't a drain. It's the foundational bedrock of their multi-brand ecosystem strategy. And that ecosystem is the very engine that will eventually outpace the cash burn. Let's break down the 3-brand hierarchy they've explicitly established: NIO, Onvo, and Firefly. Think of it like Toyota and Lexus, but engineered deliberately from the top down. By siloing the brands, they protect the core NIO premium brand, which explicitly targets those 20 to 25% gross margins, while using Onvo and Firefly to capture mass market scale without diluting the prestige of the flagship.
Scale is a highly relative term in this industry.
But the data speaks for itself. Onvo delivered 38,290 vehicles in Q4 2025.
The Onvo L90 literally became the best-selling large BEV SUV of the year. It directly targets the Tesla Model Y demographic, but it utilizes NIO's existing battery swap network, creating these immediate, powerful infrastructural synergies. And then you have Firefly, their compact urban brand. They achieved 40,000 global deliveries in under 18 months. They're aggressively scaling in places like Thailand and the Middle East, completely bypassing the new European tariffs. This multi-brand architecture is exactly why their overall delivery numbers surged by 71.7% year-over-year in the fourth quarter.
I'm sorry, but I just don't buy the premise that this constitutes an unmitigated triumph. Let me tell you why. You use the word success regarding this volume scaling, but we have to anchor these absolute delivery numbers to actual market share to understand the competitive reality. In January 2026, NIO only held a 4.5% market share in China. 4.5%. They are lagging far, far behind BYD, which holds a dominant 15.8%. They are behind Geely, they are behind Huawei's Hima brand, they are behind Xiaomi and Li Auto. They actually missed out on the number 7 spot in overall sales in January.
But they are playing primarily in the premium space. That inherently limits total market share. You have to acknowledge that.
Not with Onvo and Firefly, they aren't. They have intentionally stepped down into the ruthless mass market, and a 4.5% overall market share across all those brands combined does not give you pricing power. It makes you a price taker, not a price maker. Furthermore, you mentioned Firefly bypassing European tariffs. Let's be intellectually honest about what is actually happening in Europe right now. In February of 2026, NIO executed a radical restructuring, which is really just corporate speak for a complete forced retreat from their direct sales model in Europe. Do you know why? Because in January 2026, they sold a dismal 56 EVs across 9 European markets. 56 cars. That's not a market footprint, that's a rounding error. They are now desperately pivoting to a traditional dealer network because the direct sales and heavy infrastructure model completely failed to resonate with European consumers.
I'm really not convinced by that line of reasoning, because pivoting to a dealer model in Europe is actually a demonstration of management's capital discipline, which is exactly the kind of maturity institutional investors want to see from them. 56 cars in a month is undoubtedly a black eye, I'll grant you that. But rather than bleeding cash to force a square peg into a round hole, they stopped bleeding. They recognized the direct sales model was too capital-intensive in regions with aging demographics, entrenched brand loyalties, and astronomically high permitting cost for infrastructure, so they adapted. Isn't pulling the plug on a failing strategy the ultimate sign of mature management?
It's a sign of mature management, yes, but it also fundamentally undermines your core thesis that their proprietary infrastructure is a globally exportable moat. If it doesn't work in Europe, it's a regional phenomenon.
Let's return to the infrastructure itself then, because this really is the core of the disagreement between us, the battery swap moat. In February 2026, NIO officially celebrated its 100 millionth battery swap.
A remarkable technical and logistical achievement, I will certainly concede that.
It is a massive, tangible, competitive advantage. Over the 2026 Chinese New Year holiday alone, the network handled 2.07 million swaps. We're talking about replacing a depleted battery with a fully charged one in under 3 minutes. But the economic benefits go far beyond just the convenience of speed. Swapping physically protects battery health over the long term through systematic inspection and centralized optimal temperature charging. Moreover, these swap stations act as grid interactive assets. They can store cheap energy at night and actually balance local power loads during the day.
The engineering is elegant. There is no doubt about that. But the economics of deploying it are frankly terrifying.
Hold on, though. You can't look at the engineering without looking at the consumer wallet. The battery as a service model, or BaaS, changes the math completely. By separating the physical battery from the vehicle purchase, NIO lowers the upfront cost to the consumer by RMB 70,000 or more. And this is perfectly timed for the current macroeconomic landscape. The 2026 Chinese government subsidy extension introduces a new 5% purchase tax on EVs, but vehicles sold under the BaaS model exempt the least battery portion from that tax. This gives NIO an immediate structural pricing advantage over every single non-swappable competitor in the premium segment.
That's a compelling argument regarding the tax loophole, and it certainly helps unit sales on the margins.
But have you considered the brutal utilization math required to keep this overarching physical network afloat? Think of these swap stations like a high-end restaurant. To keep the lights on, to pay the robotic maintenance staff, and to justify the immense real estate costs, you need a certain number of tables booked every single night. The break-even requirement for a single fifth-generation battery swap station is approximately 60 swaps per day. Currently, NIO's network is only averaging 35 daily swaps per station. They are operating at roughly a 58% utilization rate relative to break-even. That is a massive structural deficit, and as we noted earlier, they are planning to build 1,000 more of these stations this year. You are essentially multiplying a loss-making asset.
The utilization rate will naturally rise as the mass-market Envo vehicles, which remember are natively compatible with the existing swap network, hit critical mass on the roads. It's a build-it-and-they-will-come model that is finally reaching the tipping point.
Perhaps. But they are racing against an existential technological threat that could render the entire network obsolete before it ever reaches that tipping point: ultra-fast charging. By early 2026, BYD and others have aggressively deployed 1,500 kilowatt flash charging piles. BYD's second-generation Blade batteries can now charge from 10% to 97% in just 9 minutes. 9 minutes. And that is even in extreme cold weather conditions.
3 minutes in a swap station is still 3 times faster than 9 minutes on a plug.
Structure. Consumers are already used to plugging in their smartphones at night. Plugging in a car is a natural behavioral extension. Why would a consumer tie themselves to a proprietary, heavily subsidized, mechanically complex swap station? Or why would a partner automaker adopt NIO's standardized physical battery packs when standardized fast charging tech is advancing so incredibly rapidly? The gap between swapping and charging is closing fast, and installing a 1,500 kilowatt charging pile is exponentially cheaper and easier to permit than building a massive robotic swap station filled with millions of renminbi worth of idle batteries.
I understand the fast charging argument, and 9 minutes is impressive, but you are assuming the municipal power grid can actually handle millions of EVs simultaneously pulling 1,500 kilowatts. It can't. To put that into perspective, 1,500 kilowatts is the equivalent power draw of an entire small neighborhood block. If 3 fast-charging cars plug in at a highway rest stop at the exact same time, the local grid will literally brown out without massive localized battery storage. That's why NIO's swap stations, which charge their internal batteries slowly during off-peak hours and store the energy safely, are highly favored by municipal grid operators. But let's translate this operational debate into the valuation mechanics, because that's really where the rubber meets the road for the stock price. We established earlier that the stock is heavily shorted.
147.25 million shares.
Yes, it is a highly volatile setup. The setup for a massive short squeeze is clearly visible when you look at the dense 2026 catalyst calendar. We have the ES9 flagship SUV unveiling coming up in April, which will absolutely solidify their dominance in the high-margin RMB 400,000 plus segment. Following that, we have the critical Envo L80 launch in May. If the L80 pre-orders as are strong as the L90s were last year, Wall Street analysts will be forced to upwardly revise their 2027 revenue estimates. When you run the bull narrative discounted cash flow model, which projects future free cash flows and discounts them back to present value, incorporating their target 20 to 25% vehicle margins and Envo's scaling, it pegs the intrinsic fair value of the stock at $6.24. And any surprise monetization, say a speculative secondary IPO for NIO Power, their energy subsidiary, that could force aggressive analysts to raise their targets beyond the current high of $9.45. It paves a highly viable path for 100% gain toward $11 a share.
A path to $11. Pauses. I urge deep caution here. Relying on the mechanics of a short squeeze or a speculative spin-off IPO to justify a fundamental valuation target is a very dangerous game. Let's look at the more grounded financial modeling. The bear to neutral DCF model takes a much harder look at their current cash flows and strictly models in the immense, undeniable capital expenditure burden of those 1,000 new swap stations. When you do that, when you actually account for the cash they have to burn,
It values future cash flow at only $4.77.
But that model inherently assumes they fail to achieve their stated margin targets as Onvo scales.
It assumes they operate in reality, a reality where scale is hard-fought and margins are constantly under attack. Barclays currently maintains a sell rating on NIO with a $4 price target for exactly this reason. 100% gain from the early March baseline requires utterly flawless operational execution, and they have to execute this flawlessly in a market characterized by what the Chinese government is now calling anti-involution policies.
Let's define that for a moment because it's crucial context for the listener. Involution, or nezhuan, refers to the endless inward spiraling competition where companies bleed themselves to death with aggressive price cuts just to maintain market share. The government stepping in with anti-involution guidelines is actually designed to put a floor on the bloodletting.
It puts a floor on the pricing, yes, but it means you must now compete ruthlessly on underlying technology and software, not just by blindly undercutting the guy next to you. They are facing relentless competition from BYD, whose total vertical integration allows them to dictate the structural pricing floor of the entire industry. And they are facing Huawei-backed brands that absolutely dominate the smart cabin and autonomous software narrative in the minds of Chinese consumers.
Yet NIO's Q4 results, those 18.1% margins, prove they can expand profitability precisely in the middle of that exact technological and pricing war.
Because they fully optimize the NT 2.0 platform. The lingering question, the real systemic risk, is whether they can maintain that tight fiscal discipline through the upcoming NT 3.0 platform rollout and through the massive, sprawling brand expansion across both Onvo and Firefly.
Some amount of ground here. My perspective remains firmly rooted in the empirical financial results we actually saw in Q4. The company generated a real GAAP net profit. They achieved 18.1% vehicle margins in an intensely competitive, deflationary environment. The 5-nanometer Shenji chip is tangibly driving down computing costs, and the multi-brand strategy is successfully capturing mass market volume. When a company with these structural advancements trades at a forward price-to-sales ratio of 0.53x, which is nearly half the multiple of its closest peers, the data clearly defines NIO as an undervalued, structural stalwart making a historic turnaround. The worst of the cash burn is simply behind them.
And my perspective remains anchored to the systemic existential risks that a single quarter of profit completely obscures. We cannot ignore an RMB 14.9 billion annual net loss. We cannot ignore that their flagship energy infrastructure requires 60 restaurant tables booked a day to break even, while only seating 35. And we certainly cannot ignore that a 4.5% domestic market share and a catastrophic direct sales failure in Europe reveal a company still balancing on a razor's edge. They are heavily leveraged, reliant on continuous capital raises, and facing the very real threat of technological obsolescence from 9-minute ultra-fast charging. The infrastructure discount applied by the broader market is earned. It is irrational, and it is not going away anytime soon.
We do find ourselves converging on a few critical forward indicators, however. The entire thesis, whether you are a bull looking at a short squeeze or a bear scrutinizing the balance sheet, hinges heavily on the upcoming Q1 2026 earnings report. Specifically, the market needs to see whether they can exceed their delivery guidance of 80,000 to 83,000 units without sacrificing that 18.1% margin.
Yes. And perhaps even more importantly, the May delivery and pre-order numbers for the Onvo L80, that specific vehicle is the ultimate litmus test of their mass market viability. If the L80 fails to capture market share from Tesla and BYD, the multi-brand ecosystem thesis falls apart entirely.
Agreed. We also concur that the battery swap network's ultimate survival mechanism is opening it up to competitors. The fact that 85% of the electrical energy delivered through NIO's public charging network currently serves non-NIO brands proves they already have the capacity to act as a universal energy provider. Standardizing their physical battery packs with massive partners like Geely and Chang'an is the only mathematical way they close that utilization gap between 35 and 60 swaps a day.
If those partners actually commit to utilizing the architecture long-term and don't just use it as a stopgap while they develop their own fast charging tech, It is the defining variable of the next 2 years.
It truly reflects the intricate complexity of evaluating an enterprise of this nature. We are fundamentally trying to value a company that operates simultaneously as a highly cyclical, consumer-facing automotive manufacturer and a heavily regulated, profoundly capital-intensive energy infrastructure provider.
Two completely different business models bound together under one ticker symbol. The 2026 landscape offers multiple lenses through which to view EV profitability, and the data we've unpacked today shows just how fragile or resilient those dual models can be.
A fascinating dichotomy. We will simply have to let the data unfold as the year progresses.
If you like this content and want to watch more videos like this, then don't forget to subscribe. Thanks for watching. See ya!